The Clarity Act could force Ripple to sell or at least restructure more than 20 billion XRP. If this happens, it could have a huge impact on the whole XRP economy. It seems like this growth is pretty technical and dull at first glance, but if you look into what is being offered more closely, it could completely change how Ripple handles its escrow, how much XRP is controlled, and even who has to say that they own XRP. I will explain to you today what is going on, what this 20% test really means, and why Ripple may soon have to make some very important strategic moves. A part of the Clarity Act that presents the idea of a mature blockchain system is at the heart of this debate. The idea is that a blockchain can only be called developed if it meets certain levels of ownership concentration. The 20% test is one of the most important of these levels, and this is where a lot of people get it wrong about what the law is really after. This test isn't about taking votes for government. It's not about having all the tokens spread out in millions of banks. That is, the rule is directly aimed at supply that is linked to an issuer. Ripple's escrow, on-demand liquidity inventory, and insider wallets only matter if they belong to those defined holder groups and are worth more than whatever percentage level the SEC uses to enforce the law. The CRS summary says that a blockchain can only be considered stable if a small group of holders owns less than 20% of all the units that are out there. Again, 20% of all tokens in circulation are not held by anyone anywhere. Instead, 20% are held by people who are inside the system or are connected to it. That difference is very important. But when you look at the numbers behind Ripple, you can see why people are talking about it so much. About 34.19 billion XRP have been held in trust by Ripple as of January 1st, 2026. Also, Ripple holds about 4.5 to 5 billion XRP in its own account, which is not in lockup. Adding these two numbers together gives you a rough idea of the 3940 billion XRP that is either directly owned by Ripple or contractually managed through escrow. After that, you add your own assets. It is said that Chris Larson alone has more than 2 billion XRP. When you add in Brad Garlinghouse, Monica Long, and other early Ripple employees and leaders, you have a very real question. Does this group of named holders have more than 20% of the total? I want to make something very clear before anyone gets scared. However, I am not a lawyer for Congress. I'm not part of the SEC. I'm just looking at the text that is being talked about right now and how it is summed up in public. This language might change. Changes could be made to the limits. The terms might get different, but if the bill passes with this system still in place, Ripple will probably have to make it very clear that insiders and affiliates do not control more than 20% of all the XRP that is out there. Now, things really start to get interesting because Ripple only has a few reasonable choices at that point. The first choice is to keep the current speed. This means that 1 billion XRP will continue to be released every month, with about 60 to 80% of that amount being put back into escrow and the rest being used for on-demand liquidity, partnerships, and business reasons. This makes the reserve last for many more years while keeping the net new supply pretty low. This is the least disruptive choice from a regulatory point of view. It keeps supply stable from a market point of view. The second choice is to strongly re-escrow. Ripple could raise the amount of each monthly tranche that is locked back up, or it could even move tranches that aren't being used into escrows with longer terms. This is a strong sign that Ripple is lowering float on purpose to meet new rules and standards for the market structure. It doesn't lower the total supply, but it slows down movement and makes control seem less secure. Burning on your own is the third option. Ripple could send XRP to addresses that can't be found again, permanently lowering the total amount. Technically, the protocol already spends a small amount on transaction fees, but this would be a much more bold and planned move. The trouble is that a nuclear option would be to burn tens of billions of XRP. It removes assets on Ripple's balance sheet for good and could have legal and accounting effects that are hard to predict. Structured distributions is the fourth choice. Some of the unlocked XRP could be sent to ETFs, institutional custody products, or long-term liquidity plans by Ripple. Those tokens would not be directly controlled by Ripple. Instead, they would be stored in cars that are controlled. This could change how ownership concentration is measured. Fifth choice is a third-party or public trust. Ripple could put some of its assets in multi-signature escrows or even structures that are supervised by the government. This is where the XRP community's interest in conspiracies really heats up. Because Ripple would have to say who owns or controls some escrowed XRP if they were forced to. If some of that XRP is linked to governments, central banks, or international institutions, that information alone would completely change the story. This is where the stories come in. Some say that JP Morgan, BlackRock, the IMF, the BIS, or even the US government has direct or indirect ties to the production of XRP. The big question that everyone asks is easy to answer. Just what will Ripple do if this bill passes the way it is now? Personally, I don't see why tens of billions of XRP should be burned. That is extreme, can't be undone, and hurts Ripple's long-term plan financially. I also believe that keeping the current throttle in place might not be enough if regulators find that escrow is still an insider-controlled supply. Aggressive re-escrowing, organized institutional parking of supply, or changing the law to change who is considered an affiliate holder are the more likely options. When it comes to regulatory policy, Ripple is very smart. They've been making plans for this kind of thing for years, which is why talk is inevitable. It's possible that Ripple already has deals with big banks, governments, or other groups. Some escrow funds may not count toward insider concentration if they are already legally committed to sovereign or quasi-sovereign entities. This depends on how the law is interpreted. That would explain why Ripple has always been so careful about how escrow is set up, when leaks happen, and how information is shared. Dubai has just made Ripple's RLUSD an official currency. Circle's USDC, Circle's EURC, and Ripple's RLUSD are the only stablecoins that the Dubai Financial Services Authority now approves for use in the Dubai International Financial Center. The DFSA has updated its crypto rules and officially accepted this very short list as of today. The biggest change in crypto right now is that the government will no longer look at each token separately. This is a big change that most people don't see coming. In the past, every token had to go through a lengthy review process that often also meant it was approved by the government. It used to be that the regulator looked at each project individually, but now they use a framework based on parameters. There is a set of rules that a token must follow in order to be qualified. This model is a lot like what Abu Dhabi's ADGM already uses, and it now fits in well with other changes being made by the DFSA to crypto. These changes aren't just for looks. They might include a complete ban on privacy tokens and new rules about how to handle assets, set up crypto funds, and make institutional products. This is a clear sign that the DFSA is building a controlled but expandable digital asset system that supports assets that are compliant, open, and ready for use by institutions. Things are even more important when it comes to stablecoins. Only 3 stablecoins have been approved by the DFSA so far. These are Circle's USDC, Circle's EURC, and Ripple's RLUSD. This is a very important point that many people fail to see. Stablecoins do not need a license from the DFSA. It knows who they are. What this means is that only a very short, carefully chosen list is allowed inside the governing area of the Dubai International Financial Center. It was already clear that algorithmic stablecoins were not included in crypto tokens backed by real currency, but the policy statement released today goes a lot further. Other big stablecoins like DAI or Sky are not based on algorithms, but they do have a lot of crypto exposure and private credit holdings in their funds. The DFSA has now made it clear that stablecoins that are qualified must have reserves that are worth the same amount of the reference currency. To put it another way, if you say your stablecoin is USD, your reserves must be in real USD or assets that are equal to USD. There won't be any crypto, private credit, or hybrid systems. This is the main reason why this event is so important for RLUSD. Banks, fintechs, exchanges, custodians, and funds with a license from the DIFC can legally use and market RLUSD for payments, trading, settlement, and treasury operations inside the center, just like they would with USD or EUR. This isn't access to ideas. The financial system here is live and regulated. The DFSA had already given the go-ahead for RLUSD to be added to Ripple's DFSA licensed payments platform. Just that could make it possible for thousands of DIFC companies to use RLUSD for settlement flows across borders. This is where things start to get worse. Ripple already has a license from the DIFC to be a blockchain-based payment service. They are building up more facilities for custody and tokenization in the UAE. There is work being done on tokenizing real estate with Control Alt and the Dubai Land Department. Ripple can now offer an institutional stack that is vertically integrated, since RLUSD is one of only 3 stablecoins that are accepted by the same regulatory body. In one controlled hub, you can make payments, store your coins, tokenize them, and use stablecoins. This gives Ripple a special edge in the Middle East, Africa, Southeast Asia, and anywhere else that does business through Dubai. The RLUSD is one of the 3 stablecoins that can be used. The future is coming and everything will run on computers. Tokenization is happening in settlement, finance, collateral, payments, and the giving out of assets. In that future, getting access to regulators is more important than hype. That's why this is important. In this case, let's talk about what XRP does. As more institutions use RLUSD, XRP can still be used as a bridge asset in areas where there isn't a lot of direct currency or RLUSD liquidity. It's easy for the same institutions that accept RLUSD to use payment options that use XRP. This is a less obvious but still important result of stricter rules. If algorithmic and crypto-backed stablecoins aren't allowed, companies that follow the rules will naturally choose options backed by fiat currency, such as RLUSD. That indirectly makes the XRP market more liquid because all of the payment infrastructure is now built around Ripple's controlled stack. There are more institutional flows, more lines that work, and more demand for bridges, all of them strengthening the same network. Brad Garlinghouse was the best person to ever explain this. He said that a token's long-term value depends on how useful it is. In what way does it help? Just how bad is that? How many people actually use it? It is very clear what the trouble is for Ripple. About $27 trillion is sitting in banks around the world right now, just waiting to be used to make payments between banks. That cash is not being used. Its only purpose is to handle payment problems. The way Ripple sees it is easy. To move that money around in real time, you can use a digital asset like XRP. It takes about 3 seconds for XRP to settle. It takes days to do traditional correspondent banking. That's not a change in marketing. Of course, that has to do with technology. One thing is going on in the United States on the political side, while this is going on in Dubai on the regulatory side. Big banks aren't going to wait any longer. Morgan Stanley now fully backs Bitcoin, Ethereum, and Solana ETFs. The company has 15,000 advisors, millions of clients, and 1.5 trillion in assets under control. A lot of wealthy clients are already getting spot Bitcoin ETFs from them, and now they want to own something instead of just getting publicity. Crypto is now being added straight to traditional portfolios, and this isn't a change in retail, it's advisors. It's people who handle money. Brokerage systems are what it is. In August 2024, Morgan Stanley was the first big U.S. bank to let its 15,000 financial planners pitch spot Bitcoin ETFs. At the time, it was still not popular or well known. They are now making plans to start their own ETFs. This is a huge recommendation. In the first few trading days of the year, institutional cash is already coming back into the market. This comes after months of net losses from spot Bitcoin ETFs in late 2025. Most of the money that is sitting in spot Bitcoin ETFs is now in BlackRock's IBIT. And if you work for Morgan Stanley, it makes perfect sense. You could sell someone else's goods instead of your own, so why would you? The company is also going to let E-Trade customers trade and keep crypto assets directly. In other words, Morgan Stanley only sold crypto risk to clients with a net worth of more than $1.5 million in 2024. This wasn't being sold to a lot of people. They were going after wealthy people and family offices as clients. They were pushing BlackRock and Fidelity's Bitcoin products at the time as the main ways to invest. Before most other banks did anything, they were the first ones to act, even though it was risky. Now, not long after that, we are seeing that early positioning turn into full-scale establishment adoption. There was even a joke about, I don't know whether that's scary or good. And to be honest, that response shows exactly where we are in this cycle. Because institutions don't move for attention or jokes. Moving when the infrastructure is ready, the rules are close enough, and they think the rails are about to become important. Now let's talk about what happened in the market for XRP ETFs. $24 million poured into spot XRP ETFs with just 2 hours left in the trading day. That number went over 30 million by the end. That night, we checked the tracker and saw that it had reached 33.5 million for the day. This is the part that really counts. About 78% of all the XRP that is available has been put into spot ETF designs so far. Right now, it's just above $2, and even though the market is down, XRP saw the most growth in spot volume across all the major platforms. The volume on Kraken alone went up by more than 40,000%. That's demand at the base level. In this case, assets act like this when they change from speculative tools to functional rails. The signal is right in front of you. There was more trade volume for XRP than for Solana, Ethereum, and even Bitcoin on Kraken. XRP was taking in institutional flow during a risk-off market when most assets were losing value. That doesn't just happen. It takes place when an object is being put into a system. That has a direct link to something else that is getting more and more important: how world financial ledgers are put together. I want you to give this clip some serious thought because it shows the future of this whole area better than almost anything else. It was a simple sentence. Is it possible to run all of the world's financial systems on a single ledger? The laws of physics say no. Just that one idea breaks down a lot of maximalist ideas. It's not being said that Ethereum, Solana, or any other chain is bad. It has to do with architecture. When all transactions have to go through the same consensus process, you have no choice but to do two things. First, you move a lot of activity off-chain because it doesn't make sense to send low-value transactions that happen a lot through the world's most expensive database. That goes against the point of having a clear, unified method. Second, you break up composability. In Ethereum's case, the rise of layer 2s was meant to help with scaling, but it actually split the economy in two. It is not possible for items on different layers 2 to be put together naturally. Now you need solvers. You need to build bridges. There must be routing steps. Is that being honest? Solvers and bridges are not what blockchain composability is all about. They're a way around it. You end up with several partially separate domains connected by weak infrastructure instead of a single, elegant, globally composable banking system. That is not a base for worldwide banking. The way Ripple sees the world is very different in this way. There has never been a case for a single world ledger from Ripple. They have made the case for a group of shared ledgers. One world with many currencies. A system where different ledgers are good at different things and money can easily move between them. This is the reason why compatibility is more important than maximalism. Now you see why bridge assets are important. This is why XRP's job is not to replace all chains, but to link them together. These are the exact words people mean when they say the future will have more than one currency and record. There is no one chain that can handle world banking by itself. There isn't a single consensus method that works well for all use cases. In the future, standard tracks will join a mesh of specialized systems. When BlackRock controls ETF flows, when controlled hubs like Dubai pick only 3 stablecoins and RLUSD is one of them. And when XRP leads volume in a red market, these are not one-off events. The signs are coming together. Also, this is the hard truth. A retail does not build banking systems. The institutions do, the regulators do, it's the infrastructure. Rails move price, not the other way around. The real question isn't if crypto will be subject to rules. It's whether rules will come out quickly enough to change who runs the rails. This is an election year. This is the year when Congress and the Senate are really under a lot of pressure to make things clear. It feels like now or never. If the US doesn't come up with a clear plan, money will keep moving to places like Dubai, Singapore, and the EU, where rules are already starting to work. This is something Ripple gets. This is not advice about money. That's why they're building outside the US while they talk in the US. That's why they are putting RLUSD in hubs that are controlled. In order to avoid this, they are matching XRP with the flow of payments between institutions instead of individual traders. I believe the answer to the question, where do I fit into all of this, is easier than most people think. Choose the next popular coin is no longer the point. This is about figuring out which networks will be a part of regulated finance, which assets banks will use, which rails will carry real money, and which projects will still be around when tokenized finance is the rule.